The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and welcome to the webinar where we're going to present the results of the 35th Annual Deltek Clarity A&E Industry Study. It is 1 o'clock, so we are going to wait just another minute or two before we get started, so please hold tight. Okay, well, good afternoon, everyone. It is just about 1:02, so we're going to get started here. My name is John Bornstein. Thank you very much for joining us today. This is always a really fun time at Deltek where we finish up the analysis of the Clarity Survey and we're able to share it with you. So I am here in Boston, Massachusetts with Chad Livingston, who I will introduce in just a moment. So as promised, here is our agenda for today. We are going to provide some context for this year's report, and then we're going to dive into 6 key operating benchmarks and what we saw in 2013. Based on our analysis, we are going to share the market outlook that firms have for 2014 and beyond. And then, as always, one of the values that we like to provide is to call out the high performers and look at their results and look at the strategies that they are using to be successful. So that is what we're going to do today. So the first thing I would like to do is introduce my colleague Chad Livingston, who is going to be our expert for the next hour.
Good afternoon, everyone. Thank you very much for joining us this afternoon. I'm Chad Livingston. I'm the Senior Manager for the Vision Consulting team here at Deltek, and I also act in the capacity as Solution Architect for a lot of our international and domestic implementations.
Okay, thanks, Chad. So before we get into the content, just as a reminder, what we do on every Deltek webinar is that we've got content for about 45, 50 minutes, and then we want to answer as many of your questions as possible. And what we do is we use the Q&A pane in GoToWebinar. So we're going to get to the questions at the end, so as thoughts come up, please feel free to type in your questions now. So I will provide just a little bit of context before I turn it over to Chad. So if you're not familiar with the study, or as a refresher, this is what we consider to be the oldest and largest financial benchmarking study in the A&E industry. This is Deltek's 35th year performing the study. Submissions were accepted between January and April of this year. And again, we're looking at calendar 2013 financials. We're really excited for a couple of reasons. One is that we had more than 350 US and Canadian A&E firms participate in this year's study. That was a significant increase over last year. And one of the reasons is we need to give a special thanks to our association partners, ACEC, ACEC Canada, and SMPS. They partnered with Deltek as a way to broaden the reach of the study. So we appreciate their help, and also as a value to their members. So with that said, I am going to turn it over to Chad, and we're going to get to the good stuff.
So of those 350 different participants that we had this year, the slide here that you see here is basically the mix in terms of primary market segments. So if it's tagged as an engineering or an EA firm, that means that the firm self-reported that most of their business is from engineering disciplines and may have some architectural disciplines as part of their business. Vice versa, for the architectural firms in the architectural segment, we're looking at firms that are predominantly architecturally oriented but may have some engineering capacities in the firm. So taking a look at the firm size, I think that this is very representative of the overall market, where the vast majority of the firms, by sheer numbers, are under 250 employees. So we took a look at some Dun & Bradstreet numbers that we had, and this mirrored up very, very nicely with those numbers. Bear in mind that this is just our North American friends and colleagues. So,
okay, so that's a little bit about the study. So, Chad, why don't, before we get into the key benchmarks, why don't you just provide a high-level overview of what we saw from the responses?
We are continuing to see slow and steady improvement. We are continuing to see that the leading firms outperform the rest of the pack by a fairly significant margin. You know, the Architectural Billing Index continues to fluctuate. It's on a downward trend. Hopefully, that's indicative of the really horrible winter we had and that things will pick up here over the summer. The design and new project measures were actually up in April over March, so let's see if that continues to trend forward. Just another point relative to the climate, the ACEC Engineering Building Index for spring 2014, that survey came back with 66% of the participants saying that the economic climate was better today than it was 6 months ago. But the flip side being that only 50% said that they expected profitability to improve. So we're seeing improvement. There is still plenty of room for growth. There is still some uncertainty in the market, and I think we're going to continue to see that over the next year.
Okay, thanks for that. All right, so benchmark number one, operating profit.
Operating profit on the average came back at 11.1%. Very solid number. Continues to grow year over year. If you take operating, that is pre-tax, pre-bonus, if you take that on total revenue, we were looking at 8.8, which is a 0.9% increase over the total revenue profit point from last year, which was 7.9. In the next slide, we will take a look at the range of operating profit that we saw for this year. And I think it's a pretty interesting graph to demonstrate the spread and the breadth of operating profitability that the participant mix indicated. You know, 5.8 to 17 being that middle 50% of the overall participants. Some firms being able to achieve 47% operating profit. That is a really impressive number that I'm sure all of us would love to achieve one of these days. So taking a look at the 10-year trend, we continue to climb year over year, coming out of the 2009 Great Recession, or Great Recession, I guess is what everybody kind of continues to call it. We're still just shy of that 2008 number when things were starting on the downward trend. So there's room to improve, and continue to push forward. You know, I think that at some point in time we'd all love to be back up in that 2006 range. So, and I think that this number is probably not going to be very surprising to too many of you on the call. Take a look at, and we're going to be doing this for each of the metric areas, take a look at the breakout and in terms of firm size and in terms of self-reported market segmentation. So the operating profit rate is a 1.5% increase over last year for the smaller firms, a 2.5% increase for larger firms, and medium firms were pretty consistent with last year's numbers. When we look at it by sector, we had a less than 1% decrease for architecturally focused firms and a 1.2% increase for engineering firms. So upward momentum, hopefully we'll see that trend continuing. So, you know, I think this is probably going to be fairly self-explanatory to everyone on the call. What drives operating profit? Higher fees, higher revenue numbers, higher net revenue. The ability to convert labor to revenue efficiently and ensure that we have an appropriate staff mix, and controlling the overhead costs, particularly labor, because that's, I would hope, everyone's biggest expense. We'll talk more about controlling overhead costs and what we think we're going to be seeing in the next year or two relative to that. Again, things continue to be moving in the right direction, moving forward, as one firm improves, most other firms also tend to improve.
Okay, so that's number one. Number two, net labor multiplier.
And this is one everyone probably loves to hate. So net revenue divided by the cost of labor charged to the project. I know many firms use this in a project metric perspective. 299, a very respectable number. I think that the average, that's pretty close to the average target multiplier that I see. And so we're pretty pleased with that number actually coming up those 0.08 points from the year over year. So it's a 2% increase year over year from 2012. In terms of the segmentation, what we're looking at is we saw that small firms had that same 0.9, increase in net labor multiplier over 2012. Medium-sized firms showed the same increase, and large firms actually reflected a 0.15 reduction, so 15/100ths of a reduction in net labor multiplier. And there was very little change in terms of the net labor multiplier for architectural firms. Engineering firms actually saw a 7/100th of an increase in year-over-year growth. So net labor, what drives it? Increased fees and billing rates, higher overall revenue, containing the labor costs, salaries and headcounts, what's being charged to the projects, is it appropriate to be charged to those projects? And one of the critical things that we'll continue to talk more about this afternoon is project management culture, project management awareness, budget and schedule awareness, ensuring that the financials that you're expecting are the financials that you're getting. We saw on that trending slide that we've been looking at the same range for about the past 3 years with gradual improvement. So hopefully next year we will see that cross the 3.0 threshold. We know that it continues to be a very competitive market, that it's very hard to drive fees up or to get time materials rate increases. And one of the other things that's going to continue to impact that net labor multiplier, I think, is that those high-value, highly skilled employees are in high demand. People are hiring again, which means that your key people may very well be at risk. For 2012, we saw a 12% overall staff turnover rate, which was up 2% over 2012. If you stop and take a second and think about the cost to replace an employee is estimated at about $70,000 between opportunity cost, lost revenue, the time it takes to onboard them, and then in some cases, the corresponding recruiting expenses attached to it. So it's a lot cheaper for all of us to try to retain key employees than it is to let them get stolen by other firms.
Okay, let's bring it over to utilization.
So the first two factors, obviously, that we were looking at tied with revenue, and utilization is one of those ones that we all pretty much take a very close look at and keep a very close eye on. Our utilization is calculated as dollars, and it includes vacation, holiday, and sick time for all employees in the firm. So for this year, we posted 59.4 as an industry, with the factor that some clients of ours use, which is excluding vacation, holiday, and sick time, was 65.6. Last year, that was 59.9 against 65.4%. So utilization, wow, that's pretty flat. Actually, a little bit of a downturn in overall utilization ratios. So how are firms getting increased net revenue? They're driving higher fees. That's really what it ultimately boils down to. So in taking a look at the segmentation, overall, from a staff size perspective, each segment had less than a 1% change from 2012. And it's important to remember that these are labor dollars, not hours values. So everything else being revenue driven, if this is flat, I think we'll see the impact of that a little bit later on with some of the other KPIs. In terms of architectural versus engineering, architecturally focused firms saw a 2.5% increase in utilization, whereas engineering firms actually saw a 1.4% decrease in utilization year over year. So having the right resource mix, operations working with HR, making sure that you're appropriately staffed, that you have the right skill sets is an obvious key factor for utilization. Do you have the right admin to professional mix? Are your mixed employees, are they charging more to projects? Are they charging more to marketing? And I think one of the other factors is that we're probably seeing more marketing dollars or more marketing labor. That's part of what may have driven down that utilization factor for the year. Another absolutely critical factor when we're talking about utilization is having effective and good project management, where your project managers are aware and they have visibility into what people are charging to their projects. We saw the trend on it is flat. So how can we continue to drive growth if we have relatively flat utilization? And it's going to really hinge upon our ability to drive additional fee and or revenue or bill rates.
Okay. Next benchmark is the overhead rate.
So overhead rate actually went down year over year. This year we are at 161.1, which is a pretty significant or pretty strong number there from an overhead rate perspective. Our calculation does exclude bonuses. That rate for this year, including bonuses, was 180.3, whereas last year is 175.7, which is indicative of some of the other trends that we're seeing in terms of an increased variable compensation payout for employees. Now, what was really surprising to me when I was taking a look at the trending is that we were flat. I actually expected it to go, I was hoping that it would go up, indicating ideally a reinvestment in our employee base. Given that it's flat, it tells me that we may not be making those investments or that we may be offsetting them somewhere else. So my hope is that we're reinvesting in our employee base, we're giving back benefits, we're reinvesting in training and professional development, which can only help us drive further revenue downstream. So let's take a look at the segmentation. Large firms actually saw a 7% decrease in overhead rate from 2012. Medium-sized firms increased their overhead rates by 5%, and small firms saw little to no change. Whereas architecturally focused firms saw a 4% drop, and engineering firms saw a 3% increase in overhead rates for this year. So, like I said, hopefully we're reinvesting, we're rebuilding our staff counts. I think one of the metrics that we talk about a little bit later on, we'll share that information with you. So, again, back to that triangle of reducing indirect labor through increased utilization, billable work, being sensible about corporate expenses, and finding the appropriate balance for between employee benefits and retention. I think that is absolutely critical to point out. It may, let's hedge the bets and make sure that we're investing in our employees and that they are feeling valued, and so that the next firm that comes along isn't going to be able to snatch them up because the next firm has a little bit better benefit package, a little bit more focus on training, professional development. That is one of those factors that we all know is key to our high-value, high-skilled labor leaving the firm. When I was presenting the preliminary clarity results to the ACEC back at the end of April, I asked the room, I said, how many of you have lost a key staff person in the last 12 months? And about 75% of the 100 people in attendance raised their hand. That means that your peers, your counterparts, or your competition are taking away key staff members. So I would expect that over the next year or two, we're going to see a slight, hopefully, uptick in overhead rates from the perspective of reinvesting and doing some catching up spending from an employee retention perspective. So total payroll multiplier is one of those ones that's a little bit harder to game in terms of the question that's out there is less about, well, where do you charge your hours? Where do employees hide hours? Do they fudge? That kind of thing. Because it's calculated as utilization rate times net labor multiplier, or by dividing net revenue by total labor. So this factor is a pretty strong one in terms of being indicative of overall performance for firms. And much with the utilization, it's down a little bit. It's fairly flat because it does take that overall payroll value into account. And similarly with the market segmentation, much like what we saw with the utilization ratios, these ratios, when compared to 2012, were flat. There was no significant movement in any of the segmentation from 2012, which leads us into, why is it important? So obviously, driving revenue. That's where we're going to get the growth. We're not going to get the growth from a utilization perspective, I don't think. And ensuring that we have the right resource mix. I know I may sound a little bit like a broken record, but that is absolutely essential for our industry. It's much with the utilization. It's been flat for the last 3 years. And it, like I said, it takes that gaming out of the situation. So how are we going to get that number up? Driving additional revenue. How are we going to drive additional revenue? Chances are, given the fact that we have such tight constriction when it comes to fees and rates, it's going to be through more effective project management, asking for those change orders that you might otherwise let slide because it's a long-term client, and visibility and ensuring that our management teams have the appropriate visibility to make those decisions about whether or not you should be going after a change order or whether or not you're appropriately staffed. So that visibility and the appropriate use of tools is going to become much more essential if we're looking for growth down the line.
Okay, so that's 5. So what is our, let's go through our 6 key benchmarks.
Net revenue per employee. So total net revenue divided by staff. That is total head count, including principals. Posted a very solid 127,000 per employee number, which is up, obviously, over last year. Believe that was about a 2% growth year over year. Now, the segmentation, I think, is where we saw some more significant swings. Smaller firms saw a $7,000 per year increase, or per employee increase. Medium-sized firms showed a $3,000 per employee increase. And large firms showed a phenomenal $12,000 per employee overall increase. Best guess, based on these numbers, most of those larger firms were architecturally focused, because architectural firms had an $11,000 increase per employee, whereas engineering firms saw predominantly a $5,000 increase year over year. Staff productivity, resource mixing, increasing fees. How do we increase fees? Demonstrating value pricing. One thing that we do take into account with this is inflation. So it is adjusted for inflation. And it continues to go up from recession lows, but we definitely are not back to where we were in 2008, much less 2006.
Okay, so those are the 6 key benchmarks. So one of the other things that we do with Clarity Study is look at where firms are expecting their growth and where they're going to make their money. So, Chad, what is the general consensus of growth in 2014 and beyond?
So anticipated growth for revenue is 5.6%, which is a nice 2.4% over last year's estimate of 3.2. So for those of you that join us for this call next year, one of the things that I'm going to be focusing on is, did we actually achieve that number for our year-over-year estimate? So it'll be very interesting to see. Now, this next slide really reflects that continued optimism in the overall market. The key thing that I see here is that we are expecting work to grow. And if you dig this slide out, or this page out of the final presentation when you all receive it via email, or if you get a hard copy, one of the most interesting things to me about this particular aspect of the survey was that we saw firms re-entering markets that they did not indicate that they would be entering in 2012. So that reflects, again, that continued optimism that, okay, we're back into growth mode a little bit. And that re-entry was actually indicative across all 4 of these market segments. So that was also very interesting. Much like with last year, and I think in terms of year-over-year changes, they're more likely attributable to our increased participation rather than a real trend or shift in the market. Not a significant amount of work for most firms based on rehab, retrofit of green buildings. The major versus minor, or the major versus not a source of work, pretty much split as it was last year. So no major shifts being anticipated in terms of rehab, retrofit for green buildings, nor was there a overly significant shift in the importance of international business. Most firms that participated in the survey, we saw the mix. It was 80–90% under 250 people. Historically, that size of firm does not participate in the international market. What was interesting, though, was that there was some decent shifting between slightly important to very important, and very critical actually went up. So those firms that do focus on international business are increasing their focal point and how important it is to their continued business growth. So no huge changes anticipated in terms of technology investments. The big shift was from not anticipating technology investments in technology last year was a little over 20%. So that 5% drop was actually picked up in anticipating investment in design and documentation. So, it's nice to see that we're coming away from not spending the money on internal improvements and process improvements to looking to reinvest some of that continued growth and that additional revenue back into the business.
These next two slides will be of special interest to our SNPS members and principals in the audience.
This slide right here presents go, no-go factors. So what do we take into account when we are deciding whether or not we want to pursue a project? Now, this was one of the most significant shifts to me this year, was the shift of importance of likelihood of profitability being swapped with the high probability of win. That tells me that we are no longer just chasing work, that we are actually taking a little bit of a closer look at, is this work going to be profitable? And that was just so pleasing to me to see that we're no longer just after the work, that it's not all about bringing the money in, that are we really going to make money on this project? So let's hope that that trend continues. Existing client relationships is no surprise to anyone that is an absolutely essential factor in whether or not we propose on a project, because we all know that it takes a significant amount of money to win a new client. Therefore, we want to keep the clients that we do have, and or we are targeting a client for reentry or going into an additional market. So nothing other than this flop or the flip-flop of the likelihood of profitability and the probability of the win is very significant here. Firm success factors. Again, clients right up at the top, followed immediately by having the right people. So if that right people is as important as we think that it is, let's make sure that we keep those right people and continue to drive those, because client and employee retention are the meat and potatoes of our business.
Okay. As I mentioned, one of the distinguishing factors of the Clarity study is that we call out what we call the high-performing A&E firms. So before we look at their performance, Chad, can you just kind of give us a level set on what the criteria is that we use for a high performer?
So in our world, consistency is absolutely essential. So as with last year, the two defining characteristics that had to be in place to be defined as a high-performing firm were 15% profit and a 3.0 multiplier, both, not one or the other. So thrilling is that this year, even with our increased participation, 25% of the firms that participated fell into the high-performer range. Last year, with the 200-ish participants we had 20. This year, 25. Really happy to see that. Now, one of the interesting things that we'll talk about in a little bit is, are these results sustainable? So let's take a look at that first one of those 6 metrics that we looked at. 22.1% operating profit for the high performers. So 7% was the average. 7% over was the average. Just a little tip on reading these gauges that we have here. The red represents the bottom 25% of the firms in terms of the range. The yellow represents that middle 50% of the range, and the green represents the top 25%. So our average for the high performers was firmly in that green range. So let's go ahead and take a look at the net labor multiplier. 3.33, very, very strong, significant gap over the rest of the pack, so to speak, about 0.5 in terms of net labor multiplier. Remember, the average for all participants was 299. So even that 3.3 is still a very significant jump over the averages. Now, if you take a look, you'll see that the needle is pointing kind of low on that threshold of the green. That just means that the average of the firms fell into the lower portion of qualifying for our criteria to be a high-performing firm, which, if you remember, the high-performing benchmark was a 3.0 multiplier. So high-performing firms do not have a significant gap between the average and their postings from a utilization perspective. This particular gauge is a little bit different. High performers fell into the median, into that middle 50% in terms of their overall utilization factors. So that tells us that high performers are utilizing their employees pretty much the same. They have a similar mix, but they're able to drive additional revenue from their projects, whether that be through project management, value pricing, somehow getting increased bill rates. So this was one of the ones that I found to be very, very interesting in terms of its applicability and how the high performers compared to other firms. Not a lot of difference in utilization rates from high performers to everyone else.
Okay. How about overhead rate?
Overhead rate, again, high performers were not that different. If you remember, 1.61 or 161.1, I believe, was the overall average. 6 percentage points, not a lot when you take everything else into consideration. You know, the best firms, the top 25% from an overall overhead rate perspective, had a overhead rate of about 135. So overhead perspective, high performers are not driving their high performer status from overhead. They're driving their high performer status from revenue growth.
Okay.
Total labor multiplier, the end game of it all, 2.02 for high performers. Very respectable, very strong, very significant gap over the rest of the firms. 1.68, and remember the average was 1.74. So that's a very significant difference between your high performers and your rest of the pack. Now, it's a slight downtick from 2012 for the high performers of 0.06%. Taking a look at net revenue, 149. Last year it was 144, so almost $150,000 per employee. And again, those high performers are in that upper 25%, on the lower end for the average, but still very solid in that green.
Okay, so those were the 6 key benchmarks. As we looked at the high performers, were there any other distinguishing characteristics that we saw?
You know, staff growth was very significant. High performers are after your employees. High performers grew 8.3%, which is a 3% increase, 4% increase, excuse me, over last year. So very significant growth in terms of hiring. Bonuses per employee were nearly 4 times what they were for high performers versus all other firms. That leads to staff retention. The current ratio, 3.11, a 5/100th of a point uptick from last year at 3.06. Now, the return on equity actually dropped a little bit from last year's measure of 46.5%. But again, this is the high performers are outperforming all other firms on all of these metrics by a 3 to 4x margin on each of these metrics, which are kind of more about stability than they are about growth. Now, one of the very interesting things that we found in the study was that high performers weren't sure that they could have this kind of growth next year. They were actually anticipating a reduction in revenue from 2012 of about a 10% reduction. So maybe some of those that fell into the high performer category this year had a great year and aren't anticipating being able to repeat those same results next year. But it's very interesting to see that they're actually not expecting to be able to maintain that level year over year.
Okay, so that brings us, we're about 35 minutes into it, so we've seen the key performance benchmarks, we've looked at the market outlook, and we've also looked at the high performers. So if you had to, before we go into the Q&A chat, if you had to sum up what we saw in 2013, what would those high-level takeaways be?
Again, back to what we started off with, we're seeing continued gradual improvement in revenue. We're seeing continued gradual growth. The top tier, those high performers, those 3X factors continue to significantly outperform the rest of the firms. Now, where do they get that outperformance? Well, we saw that their utilization and overhead numbers were pretty consistent with everyone else. They're getting that outperformance on driving additional net revenue. They're able to better manage. They have greater visibility into their projects. They have tighter financial metrics and controls. They have stronger project management, project reviews, reviewing the financials, helping project managers understand the inputs and outputs so that they can make those critical decisions on their projects. And then lastly, they have a good resource mix. They're looking at their staffing. They're looking at their staff's qualifications or their credentials or their experience and making sure that they're appropriately staffed for projects and to deliver those projects profitable through strong project management. One of the other key things is accurate and appropriate use of the tools at your disposal, giving your teams the visibility into how are we doing on projects, how are we doing on the bottom line, understanding your projects, which ones are profitable, which ones are at risk, which ones are running at a loss, and how you might be able to do some course corrections. Without good insight and without good visibility into that information, we're not going to be able to see the growth that everyone wants to see.
Okay. Thanks, Chad. So as a reminder, please use the Q&A pane in the GoToWebinar panel, and we'll get to as many questions as we can. So while those come in, just a reminder that tomorrow you will receive an email from Chad with a link to today's recording, today's slides, as well as the actual Clarity A&E study itself. So please be on the lookout for that. The email will also have some recommendations that support what Chad was referring to in terms of the strong controls, whether it be marketing, project management, or financial. So let's see. Chad and I are just going to go through the questions and pick out some of the best ones.
So one question is exactly what is calculated to get net revenue. Net revenue is calculated based off of total revenue divided by, I'm just trying to get to it so I speak to it appropriately, direct labor. So total revenue divided by the net direct labor dollars from the P&L is how net revenue is calculated. Let's see.
Okay, and Melissa, you had asked a question, which was if you participated in the survey, when would you get the information? So everyone that participated in the survey, we sent an advanced copy of the report. It was a week or two ago. So that was as a thank you to everyone who participated. So let's keep a looking.
What do I think a good admin to professional staff ratio would be? I'm not sure if it's actually a staff or it's actually more of a time commitment that I think would probably be accurate. I would say probably 60-30, 65-30 in terms of total hours and distribution. That would be what my gut would tell me, and more or less what I see from some of those clients that I've worked with that I would consider to be high performers. So one comment was, since overhead rate is largely driven by utilization, reinvesting should not indicate a large increase. And I wasn't thinking that it would be a large increase. I would expect that it would be an increase, hopefully, from the perspective of driving it up a little bit. I would certainly not hope that we were going to see a 5 to 10% increase in overhead rate. So one question was, does your project include Canadian stats? We do not have the Canadian participation broken out separately in the report. We are aggregating this as a North American effort. Let's see, other questions. Lots of questions on where can you get copies.
So just as a reminder, the answer to that question is you will get a copy of the report tomorrow, along with today's recording and today's slides.
Let's see. What do you say? So just one comment that came in was the high performance had significantly higher working capital per employee and equity per employee than all other categories. And that's been true year over year. The higher performers are able to make those investments and leverage that working capital and leverage that equity to reinvest in the firms. One question was that, wouldn't you say that part of the increase in net labor multiplier was a reduction in senior, more expensive, less billable staff? Part of the increase I'm not sure that I would agree with that, because a lot of the firms that I've worked with over the past year still have a lot of their, very experienced, very senior staff, and many of those firms have actually and are looking to hire senior level staff. So I don't know that I would say that that is true. What is the difference between labor multiplier and net multiplier? So the labor multiplier, the total payroll multiplier, I want to say fifth KPI that we talked about, that is total revenue divided by total labor dollars. So that's the payroll multiplier. And then net labor is just direct labor on projects. Wow, the questions keep coming in. Thank you all very much. There was a question on high-performance firms relative to staff size. And I don't know that we have that handy. Rick Rogers, if you want to send me an email, I will dig that out and see if we can't find a good analysis on that. I think that at least last year I asked a similar question, and it was more in the medium, so in the 51 to 250 range, than it was in some of the others, although there were quite a few that were also small. But I will see what we can do to dig that number out of the raw data. Did you have a professional staff to administrative staff ratio? So one of the questions was, did you have a professional technical to administrative staff ratio average? No, we don't actually have that distribution, or we don't capture that headcount information from the perspective of the study. We're looking predominantly at dollars, because I think that a lot of firms have utilization ratios for admin staff, and so it's not consistent enough for us to be able to say yes or no in terms of the study. Let's see. What is the calculation? Higher performance.
If you can't tell, Chad's reading the questions.
Yeah, there's direct. So one question was does direct labor include benefits? It does not include benefits. Benefits from our data inputs perspective are called out separately in the survey. So one of the questions was that they're a primarily fixed fee firm that uses subs occasionally. How would you calculate net revenue on that? It's still your net labor multiplier for purposes of this study is still driven off of your direct labor dollars. So a couple questions on delivery of the survey. Some of you said that you didn't get a copy of it. I would suggest, watching your spam filters and checking for it. I assume that we're also going to have the ability to download at some point. And if you didn't participate in the survey, you will still be getting a copy of it because you registered for today's webinar. One of the questions was, are the members of high-performing groups the same ones year after year? Because we do track the survey as anonymous, we don't know that year over year. So it's one of the things that we would like to consider for next year is maybe doing some additional follow-ups with those firms that do qualify or do fall out as a high performer. Do we have a correlation of utilization rate by hours instead of dollars? Because the survey, we don't ask for inputs of hours, we do not track utilization by hours in the survey. Are marketing costs staying steady or increasing with all firms? I believe, and give me one moment, I'm going to compare the 2012 to this year's quickly. So marketing labor dollars for all participants year over year was pretty consistent in terms of other marketing expenses. Pretty consistent year over year as well. So not a big swing. If your overhead rate is high, what is the easiest way to get it down? Focus on your productive labor. Because labor is one of our biggest factors in our firms. The more labor you can actually have against regular projects while still keeping it reasonable, that's really the key factor, I think, in terms of controlling overhead. That's an interesting question. A firm has a large retirement payment obligations. Would it be appropriate to take these out of the overhead calculation like bonuses are? I would probably call that out. That's a prior performance component, and it's not so much about operations. To me, that's more of a below the line. One question was, how do you account for part-time staff in the revenue per employee calculation? We do an FTE calculation, so that's where that number comes from. What was the average revenue growth? firms doing to retain senior staff? I think that one of the key things to my mind is, ensuring that those senior staff see growth potential, that they feel that they are being recognized and equally rewarded, but they feel like that there is a continued growth path and that they have a clear path to partner, principal, whatever the firm might call it. And it's a matter of, employee retention is about whether the employee feels valued. And if benefits packages were previously cut, employees may understand the professional reason for it, may not necessarily appreciate the personal impact. Just saw one question: who is the best looking, funniest Deltek consultant? And I'm guessing that one of my staff is there, so I'm not going to say anyone. So one of the questions was, are you able to break down overhead between indirect labor and all other overhead costs? In the tables at the back of the survey, you will be able to capture that information pretty easily in terms of being able to do some additional calculations. Is the denominator in the utilization calculations W2 wages? One question was, is the denominator in the utilization rate calculation the same as the W2 wages? I believe that it would be, because hours includes vacation, holiday, and sick time, so that would most likely be directly attributable to it. However, one thing you do have to take into account with that is whether or not how you are handling the credit side of your labor posting. Is proposal time considered marketing time by definition? That's going to vary by firm. I generally personally think of marketing time and proposal time as being generally just one and the same. I think that most firms would probably treat that as marketing dollars. So one question, the firm does not enter any time off hours, so PTO, vacation, sick, on timesheets. Again, that factor is going to be driven by whether or not and how the firm handles that labor credit, or the difference between direct labor hours charged on a project against their overall gross payroll. A question about what currency we used. We assumed basically a parity US to Canadian dollar exchange rate. So effectively, they're all one and the same, even though we know that they're not. The net revenue would include the markup for reimbursable revenue. Please include a list of what higher performers are doing. We can't really speak. We can only speak to what the high performers are, what we believe that the high performers are doing to drive higher revenue. Hopefully next year we might be able to provide more detail, more specifics about what high performers are doing differently, or what things are driving their high performer status.
while Chad is looking at some information to answer a question. So while he does that, let me just put this slide up here. So everyone's going to get an email, as you know, with the study, the slides, and today's webinar recording. So what we encourage everyone to do also is contact Chad or Deltek with any questions. You can reach us on deltek.com, also on Twitter at Deltek Vision. And if you haven't subscribed to our blog, please do that also. Chad and many of the Deltek experts are on the blog, and if you comment or post questions, you will get answers. So please do engage with the Deltek crew. And let's see, we are sitting at a couple minutes before the hour, so why don't we take one more question.
So a couple of questions. One was regarding, is depreciation considered part of operating expenses? Yes, it is. And resale of equipment would fall out of the overall revenue because that would be treated, in my mind, below the line. So not part of operating expenses, just for a couple of points of clarification.
Okay, so with that, we're at the top of the hour, and we want to respect everyone's time. So thank you again to everyone who participated in the study. Thanks to everyone on the phone today for dialing in. We look forward to hearing from you if you have any questions. And equally important, we look forward to everyone participating in the 2015 study that will look at 2014 results. So thanks very much to everyone, and have a fantastic day. Bye-bye.